Hello, welcome to IVoT Ion Investing, a discussion of the markets and investing from a long-term fundamental perspective, hosted weekly by IVoT Academy. I am your host, Ed Butowsky. We are joined by two esteemed IVoT experts, market analyst Andrew Tang and investment analyst Emile Westergaard. Andrew will take a look at this week's market, including the tame inflation data, how that may impact the expectations for future Fed rate cuts, as well as an update on China and U.S. trade negotiations. Emile is going to analyze on a fundamental basis Apple this week using the world famous IVoT Forecaster. Welcome, Andrew, and welcome, Emile.
Thanks for having me.
Soon to be world famous, yeah.
Yes. So Andrew, why don't you take us through the economic data and the CPI and the tame numbers that we saw and how that is going to impact the Fed funds?
Yeah, that's it's a very good read that we are continuing to see. We are basically seeing CPI or inflation data continue to come down. And that gives us relief that the Fed has room and the ability to restart cutting rates. One is to help refund the task that we have to basically bring the manufacturing facilities back to the US. And second is really to give a lifeline to the real estate sector and all the private businesses that really depend on lowering costs of capital for all the loans that they have to roll over. So that's what's happening. And we're happy to see that inflation is under control.
So do you believe we're going to see 4 rate cuts before the end of the year?
Probably not. Most likely, we're going to get 1 or 2, but it's really important for the Fed to restart lowering rates so that some of the sectors that, especially in the private area, that can have a lifeline. Because right now, it is, again, business is still very much frozen for the real estate sector and all those private companies.
Yeah, my read from most people is that they don't know if rates are going to go higher or lower, but once they get a clear direction, then they can make some forecasts.
Yeah, that's correct. The probability of rates going higher, it's really slim. We do see that when the inventory runs out from businesses that were purchasing ahead in the first quarter, January, February, and March, when that inventory runs out, most likely the US consumers are going to be hit with higher prices. That's the general consensus, especially, running across from different sectors, from auto manufacturers all the way to, smaller novelties. But what type of impact is that going to have? That's really still up in the air because the tariff deals are basically cut across different products with different companies, and it's not exactly same across the board. So we are still, waiting to see what will happen, but the short-term inflation or higher prices are expected. Let's say come around June, around this time of the year. So we're expected to see some price adjustments.
So we focus mainly when we talk about rate cuts on inflation, but the real most important thing is the strength of the economy. And the economy has been very, very weak. So lower interest rates would stimulate the economy. But that would then exacerbate inflation numbers. So that's why you kind of have modern day stagflation.
That's right. It's not an easy job for the Federal Reserve to simply say, okay, based on this or that, we're going to make a policy change. And that's why they still are functioning with the dual mandate, that they are looking at the unemployment data very closely as well. If they start to see unemployment continue to trend up, then they'll have more of a reason to restart cutting rates. But if employment data continue to be hot and short-term inflation are kicking in, then the likelihood of a Fed rate cut in June, it's going to be quite diminished, and then it's going to push down towards later months of the year. We still have several FOMC meetings for the remainder of this year, and so we're still hopeful that we're going to get at least 1 or 2 rate cut in this year, and then continuing on into the next year.
So let's kind of pivot and talk about China. because China is a huge discussion when it comes to the trade negotiations. Everyone talks about all the other countries, are separate, but China is the behemoth that we have to get our tariffs straight with. And we recently had a 90-day pause in that. Where do you see the trade and tariff discussion going with China?
Well, right now it's still a lot of pushing back and forth, and the 90-day pause on the tariff has been criticized by China, saying it's not enough. It's not enough, and we all know that on the surface it's not enough. But this is really just a token of invitation for both sides to start negotiating. The real negotiation, I believe, is happening behind the scenes, and we're just not given that information. Treasury Secretary Scott Bassett is working diligently on this front, and I believe we will hear more from Scott or from the authorities later on when they are ready to release the data. But I know that on the surface, it doesn't really mean much to the businesses and to the investors. But behind the scenes, product by product and some exceptions, in certain areas are being discussed.
Okay. And any other country that seems really significant in terms of the tariff discussion?
Yeah, of course. The closest neighboring country is Mexico and Canada. Mexico and Canada and China, these are the three largest trading partners for the US, and they account for, a significant amount of our supply chains. And this whole rerouting of manufacturing facilities has, caused a lot of chaos in the Canadian economy for sure. Many auto manufacturers, for example, they already have plans or they are building existing facility or they have existing facilities building parts for our auto manufacturing sector. I mean, for our auto sectors. And so the rerouting is going to cause disruption. And again, going forward, what does that mean? Most likely, it will mean that more jobs are going to be lost overseas. They have to recalibrate. And on our side, yes, we will need more jobs, or we're going to create more jobs for the facilities. But the manufacturing facilities or the factories nowadays is not going to require as much labor, or it's not going to be as labor intensive as the factories that were built decades ago. So all told, it's going to have a net effect that nobody really knows what it's going to look like. But one thing I can tell you, one thing I can tell you that the new factories are building right now is going to be state of the art with many of the automation and robotic features.
So there was an article in Business.
Stock guy, sorry, just to throw in something here as our stock guy. Andrew, given this need to localize more manufacturing in the US, are there any companies that are beneficiaries of that we should be looking at and maybe talking about in future weeks?
I have a handful of them. These are the providers or system providers for software and hardware automation. I'll go through that list privately so that we don't have to blab it out here privately. Yeah, but top of mind is Rockwell Automation. Rockwell Automation is one of those consultants and installation providers for automations, software and hardware, and they'll teach how to do it. Palantir is another data analysis company that will take your company's data and teach you how to be more effective and efficient. And then underneath all that, there are a bunch of other companies that provides either the robots or the hardware and the software automation. And some are overseas, just a few companies are US, but a couple of them are like, there are some from Japan, there's some from Switzerland. We'll go through all that.
Right.
So there was an article in Business Insider that talked about this one man who had a company that he sourced everything in China, and it was shower heads. And it cost $294 a shower head. And he then tried to replicate that using just American sources, and it went up to $550. And then said, how many of you would buy the one from China and how many of you would buy the one from the United States? He got 600 orders on the one in China. He got 0 from the United States. So the idea that people are going to rally behind this America First spirit, I don't think is accurate. I think people care about their own pocketbook. And by the time these factories get retrofitted, there's going to cost a lot more money to build the same widget that they're building in China that they're going to be building in the United States. And it's going to be significantly higher. And the question is, are people going to pay it? And in this example, people were not willing to pay for the rah-rah America spirit. They were more interested in their own wallet.
Yeah, I have to agree with you. The immediately decision from the consumer, it's basically the path of the least resistance. It's going to be the cheaper goods. This whole tariff situation, it's a big experiment. How are you going to turn around this big giant cargo ship? You know, it takes 10 miles out to be able to make a U-turn like that. And so, do I think the US should make everything that we consume? Absolutely not. You know, we should not make pencils, you know, for example. Maybe we should make more high tech or focus on certain things that we have, you know, the available resources here locally. So I really don't believe that the US should make everything that we consume. This is not a closed off standalone country. We are a global economy. And again, this whole tariff situation, it's a big experiment and we're all going through it. And so, yeah, the
Yeah.
results are remaining to be seen.
Well, Emile, why don't you take us through Apple, which is a very well thought out company that is a growth company, but is slowly becoming more of a value company as it gets older. And why don't you take us through the analysis on Apple and the forecaster?
Yeah, so obviously we all know Apple, computers, phones, really phones first and foremost, computers, wearables, and then a services business, which I'll mention in the talk of, which is kind of interesting and becoming more important to them, meaning their cloud and the various AI-based products that they can offer. Stock is up, you know, what is it? It's 160% over the last 5 years. So it's been a really strong performer for investors. You know, as a fundamental long-term investor, you know, seems like an interesting brand to hold in your portfolio of the long term if you think they can continue to hold on to their loyal user base, right? So as a long-term investor with a very, you know, strong brand, you know, and product cycles that run in the phones every couple of years, people seem to be willing to upgrade their phones and the computers maybe a little bit less often, but the new chips they've been coming out with, these M4s and et cetera, have seemed to be pretty, you know, powerful, particularly now with AI, maybe something we can talk about at the end of this. So let's go to the forecaster, as Ed said, the soon to become world famous forecaster, and this is it. And I'm going to make it a little bigger so we can all see. Let's go. And so let's just go at it. So the stock is trading at $208. Market cap is $3.1 trillion for Apple right now. The most recent quarter, they did 26 billion in cash flow, up 5% year over year, which has an intrinsic value based on the IVoT methodology of $177. So you're paying roughly a 15% premium to own Apple right now to its current cash flow value. And so obviously you have to believe as a buyer that cash flow is going to grow in the future, you know, to be interested in investing, right? I mean, you have to believe that Apple will continue to grow cash flow year over year, probably in excess of 5%, really, to make it an interesting investment. I mean, our target investment return at IVoT, we always say you want to have at least 10% compounded return in your investment. So over 3 years, we'd want to think that this stock would be 35% higher than what it is today in value. Let's just dig in a little bit deeper, right? So it grew 5% in cash flow. Where did that come from? It came from 5% sales growth, which again, I think as a fundamental investor, I want 5% is passable for a large company like this. 10% is excellent. Below 5%, you're starting to, management's going to come under pressure, right? You can see a year ago it was -3%. Now, Apple's a very product cycle kind of company in terms of sales, right? I mean, they're so dominated by the iPhone. It's their biggest product by far, that, how the sales cycle of new Apple iPhones goes, so goes Apple's sales. On a margin perspective, you can see that their gross margins improved by 50 basis points. That's good. Profits are increasing. I would say a 50 basis point year over year increase for a company like this is very positive, very strong. And, if they can keep that up, that's a good sign. But again, net, the only offset there, just so you know, was they increased spending on R&D by about 30 basis points. They're currently spending $9 billion a quarter on R&D. And we can dig into what they're spending on, but obviously that has probably a lot to do with how they're leveraging AI in the future in their products, along with obviously the new phones and new computers, et cetera, new chips that they're developing. I'll just finish this off as an analysis by saying, well, if it's worth 15% less than where it's trading right now, we want to know as forecasters what we think the company will be worth in 3 years, in 2028. And we do that by saying, well, where are they going to grow sales? Now, if we think they can get back up to 10% compounded sales growth, that gets you up to a value of $228 per share. You've got a 10% return. But over 3 years, that's still not enough. That's only about 3% compounded. The other issue is the cost of goods, which have been coming down. And I think those are going to continue to come down because they're growing their services, which are their cloud and all of their techie back-end sales, at about twice the rate of their products. And those services have about twice the profit margin. They run at about a 50% profit margin, as opposed to the products, which run at about a 25% product margin. So if this were to continue to go up at 50 basis points a year over the next 3 years, that would take you to 53.9, 54.4. And that would get you, oh, no, I'm sorry, go down. I did it the wrong way. Sorry, hold on. That would take you down to 51. Cost would go down to 51.4, right? And that would get you to a $238 price target, which again is decent, but Apple's not cheap. You might not expect it to be cheap as a stock. It's not cheap right now, unless obviously believe that they can do more than that, which is possible. And I'll kind of leave it there and we can discuss it. What do we think is going to happen at Apple? That's the tool, again, as Ed said, and this is only level 1, by the way. Level 2 takes you into the segments of the business and where you can actually analyze the products business and the services business in much more detail. So that's our forecaster for Apple.
I think it's important to note that the forecaster, all of that information is available on any research report, and you can also get it off of Yahoo Finance and Google Finance. So anybody looking at this, I really encourage you to sign up to become a customer of IVoT Academy, because you get the forecaster and you get to be able to analyze stocks just like Emile did just now.
That's the idea of the whole platform, right? Exactly. And it's, again, all based on public disclosure. We're not making up any of these numbers. We're just simply giving you the forecasting capability within the tool.
So would you agree, Emile, that Apple has become more of a fundamental company or a value company than a growth company?
Yeah, I mean, it's so large at this point, and it is fundamental. I think if they can accelerate growth in the services business, so they have this large product business that runs like a product company, honestly. I mean, these are product margins. They're not high tech. It's not like NVIDIA selling, products at almost a 90% gross margin. Their phones cost money to make and ship and all of that. On the other hand, their services business with their installed base of customers is extremely profitable and is growing. And so it's really up to them, in my mind, to take better advantage of these Apple loyalists that they have around the world with more product, with more service, with more customization. And I think that could be I didn't get into that. And I think if you dig deeper, that could be a bigger opportunity than what I just expressed with the tool.
Yeah, I get these pop-ups of charges from Apple almost every day. And it's like $3, $7, $9. And they're masterful at reoccurring revenue.
That's the business. That's what we're talking about. But I think, to your point, if it's just kind of pop-ups that you don't know why you're paying for it, to me, that's got a limited, growth. But if it's stuff that you go, oh my God, Apple's helped me make my life better, then we start to get into, I think, an opportunity. And that's where they need to go. Because I agree with you. I mean, Apple iTunes is no longer really a lot of what they're doing on the cloud has not distinguished itself yet. And I think they need to do a better job with that, if I could say.
Yeah, I think the real premium here is the brand and design. As with a company that's paying 0.5% in dividends, I don't call it exactly a value company, even though they're sitting on a ton of cash. If they would increase the dividend or give it back to the shareholder, then I would say, yes, this is more of a value company. But so far, they have been criticized for their lateness into the AI game. I just think that Apple is being very careful to navigate around, this AI and the high tech or innovative landscape. They're more focused on privacy and grow slowly. We can see that by looking at their news for cutting off their electric car design plans. They spend $1 billion on it and they just cut it off because they don't want to chase after this particular area they're not going to excel in. And so the same that can be seen in the AI area. And so will they partner up with the future AI company down the road? For example, XAI or even OpenAI? Absolutely. I mean, look what Microsoft did, just the recent announcement that the Azure application with Microsoft is going to start using Grok. And so that announcement really goes to show that there's going to be a lot more integration with pure play AI companies to work alongside with the applications that are existing in the ecosystem. And again, I still think there's an extreme premium that you can't really replace with Apple. And so once you're an Apple user and you can afford to continue to use it, there is a high percentage of loyalty there.
Yeah.
Well, as you point, you're sitting on 120 billion in cash net, which is which is a lot. And as you said, they've been making acquisitions. They can continue to be an acquirer. They have a lot of firepower out there to selectively pick up companies that will help them. And again, I would imagine, to your point, they seem to have a strategy around, like they spend a ton trying to get into healthcare. And I don't know where that stands these days, but I don't see them as a big player. So it's really interesting how they can make, again, use of this, large committed user base.
Oh, I have to interrupt you there. There's actually a lot of exciting things going on with the wearable tech on the healthcare front. So if you still remember back in the days that you have a commercial featuring a lady, oh, I'm falling and I can't get up. Remember the life alert, these type of gadgets? Well, if you wear an Apple iWatch, that's already built in. Same thing with the EKG scan and same thing with the sleep monitoring, sleep deprivation, reminding you to drink water. All this stuff is really, really good. And it's just going to get better and better down the road.
Well, I want to thank Andrew and Emile for this insightful session. Thank you for watching IVoT Eye on Investing. IVoT's sophisticated yet simple tool equips you to analyze, forecast, and manage your financial future, including budgeting, investments, credit management, wealth planning, and business management. Please subscribe to our YouTube channel and click on the link in the description to register for early access to the platform, which will be opening soon. And we'll see you next week, and we'll have another stock, and we'll get another insightful update from Andrew on anything that took place in the previous week. So thank you very much to both of you.
Thanks for having me.
Thanks, Ed.